Good afternoon. My name is Fabio Petti. I'm a Deputy Head of Group Investment Strategy. I'm here with Marco Valli, our Chief Economist, and Alessandro Caviglia, our Chief Investment Officer for Italy. We just did our September Group Investment Committee, where we took important decisions as far as the asset allocation is concerned. But let's go one step at a time. Marco, let's focus on the macro for the Eurozone. We saw a first half with an important front loading from US enterprises trying to limit somehow the impact from the forthcoming tariff. What shall we expect on the Eurozone from the remaining part of 2025 and then 2026?
Yeah, the first half was indeed better than expected, in part due to the front loading that you just mentioned, but also because domestic drivers of growth have been supportive. Think of the improvement in purchasing power of households. Think of the rate cuts of the ECB that have been supporting investment. And think also of the acceleration of the cyclical impulse of investments related to NGU. But now, obviously, the front-loading effect is over, so exports to the US are coming under pressure, and this is going to complicate things a bit for the second half of the year, although growth is going to be still positive. It's going to be modest, but still positive, and this, I think, is important. Also important is to see that the labor market has been resilient, and this is limiting the downside risks to the broader business cycle. And also it's interesting to see that confidence among manufacturers have been holding up quite well. This, I think, is telling us that it's not just a matter of tariffs, but there are some endogenous drivers of growth which are actually supporting activity. So this means that in the second half of the year, growth will be weak but positive, as I just mentioned. But looking to 2026, which is what is really important for asset markets, I'm constructive because then we will start feeling the positive effects of fiscal policy, particularly in Germany. The effect will be slow to materialize, but once it starts, I think it will be accelerating. So initially, it will start in 26 and will become even stronger in 27 and 28. And this, I think, is important for asset markets.
On the back of this growth, what should we expect from the ECB then?
I think the ECB is done. I think that with interest rates 2%, they are probably on hold for the remainder of this year and throughout 2026. Inflation is exactly where the ECB wants to see it, 2%, maybe slightly higher in the remainder of the year, slightly lower over the course of 2026, but on average we are back at 2%. And we are back there with a downward trend in wage growth, which I think is increasing the ECB confidence about the sustainability of the disinflation process. So interest rates on hold at 2%, with still a bit of risk of them having to cut one last time, maybe in 3-6 months' time, when we will probably see the bulk of the negative effect of the tariffs. Then it's conceivable to see one final 25 basis point cut, but the bulk of the easing is definitely behind us.
Okay, thank you, Marco. Alessandro, on the back of this scenario, ECB at 2%, pretty much stable across the coming quarters. Spread that are on the corporate side quite at a low level, and at the very same time, potential political instability. This call for prudence, particularly cautious stance maybe on the long end of the curve. What is the stance that we decided on the last Group Investment Committee?
Yes, our fixed income portfolios during the last quarters have benefited from a very interesting return from Euro corporate investment grade, emerging market debt, due to the strong and steady spread tightening process. And now for Euro corporate investment grade, given the very, very low spread level in historical terms, we expect more stability than potential return. That is why we are moving from a position of overweight to a neutral position, but still maintaining it as the core allocation of our fixed income portfolio. We issue a warning towards the long end of the developed markets government curve, so 10 years maturity, 30 years maturity. We have to acknowledge that since the pandemic on, debt and deficits have been on an uptrend in the Western countries, in the developed countries, and now with the additional fiscal spending, credit metrics, the credit risk profiles of developed countries is set to deteriorate. So we strongly advise to focus on short and intermediate maturity for the US Treasury, for the Eurozone government bond. Emerging market debt, we confirm our overweight because it's a very good way to have carry for our fixed income portfolio with an asset class with a contained volatility and with a stable or even improving credit risk profile.
Very clear. Marco, let's move on the other side of the Atlantic Ocean. The mandate of the Federal Reserve in this very month is particularly tricky. On one hand, we are seeing labor market still resilient, even though showing weaker data. And on the other hand, inflation still not fully under control. What do you expect in terms of growth, inflation in the US, and then what shall we wait for the Fed to do?
Yeah, I mean, the labor market has definitely slowed down because economic activity has slowed down as well. GDP has been very volatile in the first 2 quarters of the year, reflecting a lot of temporary factors related to trade and inventories, obviously on the back of Trump's tariffs. But leaving aside the volatility, the underlying trend and the economy has been slowing down. Domestic demand has been growing at a pace of around 1.5% annualized, which is much lower than in 2024, but definitely it's not collapsing. It's actually fairly resilient if we consider all the uncertainty and the turmoil we have been going through. And the labor market, yes, has been deteriorating. Economic growth has slowed, so employment growth has slowed as well. But indications of firing have not really picked up materially. So companies have been hiring less, but they're not firing. And importantly, some of the deterioration in the pace of job creation has been driven by reduced labor supply due to tighter immigration rules. Right? And this has contributed to keep the unemployment rate at a very low level despite the slowdown in payrolls growth. What do we expect going forward? Economic activity, in our view, is going to slightly reaccelerate in the second half of the year and into 2026 because we have more supportive fiscal policy and uncertainty related to tariffs is fading. This should keep the labor market reasonably well supported and prevent a strong upward move in the unemployment rate. On inflation, we think it's just a matter of time for the impact of tariffs to show up, and we see inflation accelerating from here. Services inflation is sticky, goods inflation will reaccelerate. Federal Reserve will have to deal with inflation north of 3% for a number of months. And this makes their job very tricky. Based on pure macro consideration, we think that there is scope for one cut in September, another cut in December, and only one in 2026. So a cumulative 75 basis point of cuts, assuming it is mainly the macro that will drive the Fed's hands and not political considerations.
Very clear. Alessandro, then on the back of these scenarios, on the US, growth below potential with inflation north of 3%, as Marco just said. On Euro part, inflation at 2% with the ECB that should remain at that level for a prolonged period of time. What is our stance on the equity side?
Yes, we confirm our overall neutral equity allocations in terms of geographical preference, but we have to remind that we have an active and strong fundamental and tactical active positions in single stocks and industry sectors. When we build a portfolio, we stick to our global approach in construction, which means that when we build an equity portfolio, we allocate 60% to US, 20% to Europe, 20% to emerging markets. European equities had a strong start of the year, but then from April on, after the start of the trade war, US stocks recovered almost entirely. And today, as of today, the two markets have more or less the same performance year to date in local currency. What we expect, basically due to the trade war, we expect a flat 12-month earnings growth for European companies, whereas we expect 5% of earnings growth in the US. In terms of sector, we still think technology is our best option in terms of long-term investment theme, provided that we build a very well-diversified portfolio to manage the concentration issue. Obviously, Trump industrial policy will give boost also to industrial utilities via the infrastructure theme, the reshoring. Financials in US have been upgraded in terms of earnings expectation and will benefit from deregulation. Another way we have to manage the concentration issue is to deploy some part of our equity portfolio to equally weight strategies where we can allocate the same weight to each and every equity, so lowering the overall concentration of the portfolio. In Europe, banks had an exceptional year. Now, with the low and stable rates in Europe, we think that investors could start demand more for high dividend stocks, which are present in many different sectors. So more than an industry call, it's kind of thematic or sector or factorial call. And we have also to consider that the fiscal expansion in Germany for sure will be a key driver, a key tailwind for European industrial sector.
Thank you, Alessandro. One final question for you, Marco, is the elephant in the room. It's quite evident that the Trump administration is trying to influence the decision of the Federal Reserve. So how much probability do you attach to that scenario where Trump is even in the position to call for something close to 300 basis point cut? And what would happen to the US dollar in case this scenario materializes?
Yeah, I don't think it's very likely, but it's a scenario that is becoming, let's say, more of a risk, right? So we're definitely watching that closely. And if you will look at current market expectations, which is around 150 basis point of cuts from now until the end of 2026, you can already probably assume that the market is discounting to some extent some degree of politicization of the Fed, because for us the underlying macro is not going to justify as many cuts as the market is currently pricing in. That said, what happens if Trump takes control of the Fed and the Fed slashes rates from 4.5 to 1.5? I think it will be a problem for the dollar. We currently see in our baseline scenario euro dollar 120 by the end of this year, and above 120, around 123 over the course of 26. In a risk scenario where the Fed becomes fully politicized, then I can easily see the euro dollar breaking above 130 over the course of next year. 135 is probably more likely, if not even 140.
Clear. And that would be interesting to see what the ECB would do in that case.
Absolutely.
Alessandro, one final question for you. Leaving aside the tail scenario that Marco just depicted, but yet in the baseline scenario, we have US dollar euro around 120 by year end and even higher, 123 in 2026. What are we doing in our clients' portfolio to manage this risk?
Yes, we are confirming our underweight on US dollar, and so the cautious stance. So basically, when we buy US dollar denominated bonds, we fully hedge the currency risk against euro. And for the first time it's not that traditional, but we live unconventional times. When we buy US equities, we hedge 20% of the position because our central scenario is one that foresees a gradual, let's say, slow US dollar depreciation. But clearly, we want to hedge those 20% of our US equity portfolio to be on the safe side in case of, let's say, unexpected extreme market movement in the currency markets.
Thank you so much, Alessandro. Thank you, Marco. Thanks, everybody. We are running out of time. See you until the next one.